Hi, Kyle Frost here, independent Australian financial advisor, hoping to use my experience to put out valuable finance content in a more detailed way. One of the most common questions I get is how should I invest, or more specifically, what ETF should I invest in? Today I thought I'd go over the 5 of the biggest, how they differ, and which one I'd invest in if I had to pick one. So just sharing my screen here, these are the 5 biggest ETFs on the Australian market. As you'd imagine from the 5 biggest, they've been around for some time, so that means that they've had a number of years to be able to get to the size that they are. So here we can see the biggest by quite some margin is Vanguard Australian Shares. So that invests in the ASX 300, which is the 300 biggest companies in Australia, and that has around $14.4 billion in that fund. All the others, there's a big difference in terms of billion, but they're all pretty close in terms of you have the international one from Vanguard, so that covers pretty much every company in the world, and that's at 6.48 billion. The iShares 500, so these are quite similar because a lot of these 500 companies are in the VGS, the international one, at 6.45, and then you've got two of the older, more original in some way, Australian ETFs, and that's around $4 or $5 billion for those two, and they both cover the ASX 200, which I'll get into more in a moment. The next column shows the inflows and outflows in terms of percentages. So what that shows is are they growing in terms of they're obviously big, but are people still choosing these funds in terms of are they growing irrespective of the normal ups and downs of the market. So you can see here the ones from Vanguard and as well as the iShares one, they're still growing at a reasonable rate in terms of large flows are still going into them, irrespective of there are other ones outside of these that are still quite similar and quite competitive. So it's a competitive market, so they always have to fight for the additional funds to come their way. Some of these older ones are a little bit of a slower growth rate in terms of the SPDR, ASX 200. It's actually going out, so people are taking money out of that. It's kind of obvious in the names, but these are the indexes that they cover. I guess there's 3 in the top 5 that are quite similar in terms of they cover the Australian shares, in terms of the ASX 300 versus ASX 200. So although these are 4 and 5 are different ETFs, they're effectively the same in terms of same fee, same index. As a result, you'd expect very similar performance. ASX 300 versus ASX 200, they're again very similar because there's only the company 201 to 300 different, and they're going to be smaller companies, so it's going to make up a smaller percentage of the portfolio, and if there's a small percentage of the portfolio, that's going to have a smaller impact on the overall performance of that ETF or fund. And then so on the next column is the fees, and I guess one of the best things about ETFs, and I'd say all the ETFs on this list, is that they're very cost effective and probably the most cost effective way to invest. So at 0.07%, that means on a $10,000 investment, you'd be paying $7, and they're all quite similar. So I wouldn't be stressed on an ETF at 0.07 versus 0.04, 0.05, 0.05. VAS is actually similar to that, competition argument. They've reduced from 0.1 to 0.07. I think people, versus other ETFs like beta shares, which is cheaper again. People would like Vanguard to be cheaper, given that they're the largest. They should have the most scale, most brand recognition. But obviously that's where they've landed on the price, and as you can see, people are still investing in that fund. The next column is the spread. So it's something that's not as commonly spoken about, and I would say if you're just a one-off investor, it's in terms of if you're a long-term investor and just buying a fund once, it's not something to be overly concerned about because it is insignificant. But what the spread is, it's effectively the cost of buying and selling the fund. So a common one is everyone's familiar with brokerage in terms of it might cost you $5 to buy an ETF or something like that. Another one is the spread. So what that means, if you were to buy and sell at the exact same time and there were no market movements or anything like that, there's always going to be a spread, 0.02, 0.03, 0.03, and that means that you're going to effectively lose those funds, and that's kind of an upfront cost. On ETFs, larger ETFs and more established ETFs, you expect that to be very small, as they are in these instances. It's just something to be aware of, but it's not something I would stress about. In the next column is the yield. So this is just over the last 12 months, so I wouldn't, it's not a sitting number. So you can see here, again with the Australian ETFs, you'd expect them to have a larger dividend yield, distribution yield, compared to the, I guess, 2 and 3 international ETFs. That's a common thing in the Australian market for, I guess, various reasons. From a tax perspective, with franking credits, there's an incentive for, I guess, people to, I guess, put pressure on companies to have to pay those larger dividends. But as well as our market's probably more established in terms of there's companies that I guess are profitable and throwing out lots of dividends like the banks and different companies like that. Whereas in America, there's a lot of tech companies that might not be quite as profitable, given that I guess investors expect them to be more profitable down the track. And also in America, there's a thing called share buybacks with that. So what that means is that instead of the companies giving the money back to shareholders, they actually buy those shares. That actually, when there's I guess less supply of something, given the supply of shares, that pushes the price up. So instead of I guess people get enough income yield, they get a higher growth rate. And I wouldn't be stressed. Obviously, it's a case by case depending what an investor needs with that. But I think what's most important is total return in terms of the income and the growth, as opposed to really targeting income, because otherwise everyone would just invest in Australian shares, given it often is one of the higher dividend yielding share markets. Next column is the frequency. So I guess each of these pay quarterly, and again they all pay and they all pay dividend reinvestment. So I'm not the world's biggest fan on dividend reinvestment. It kind of creates a tax admin headache. So what happens is you obviously, let's say you buy $10,000 worth of VAS. That's one transaction, so that now you know your capital gains position. What happens when there's dividend reinvestment? That's effectively, I guess, 4 additional transactions every single year. So there's way around this, obviously, by just keeping on top of your admin and using different kind of tax reporting providers. But as you can imagine, if you hold it for 20 years or something like that, there's going to be lots of relatively small transactions that add up. So it's just a bit of a headache, especially, and probably seeing the practical side of this. Quite often someone might inherit an ETF or something like that, and having to figure out if they want to sell it, they've then got to go and work out all of these transactions, which aren't always easily available if someone hasn't kept on top of that. So it's just something to be aware of. The next one is currency hedging. So on an Australian ETF, it's just in Australian dollars, so there's no currency impact. With number 2 and 3 in terms of the Vanguard International shares and the iShares S&P 500, they're I guess denominated in American dollars. What that means is you're exposed to the currency. With VGS, that's not entirely in America. So you're exposed to the of all the various countries, like in terms of their currencies, but America's by far the largest, so you're most exposed to that currency. So what that means in terms of 2 and 3 is that when the currency goes down in terms of the Australian dollar, so if it goes from 65 cents to 60 cents, that actually is kind of a tailwind for VGS and IVV, whereas if it goes the other way, in terms of if it goes back up to 90 cents or something like that, no one knows what the currency is going to do, that means that it would actually be a headwind for that ETF and portfolio, and the performance would be lower than it otherwise would, all else being equal on whatever the normal ETF performance is. So I think I do like some, I guess, amount of hedging, so that could be a consideration in terms of there's kind of other ETFs in addition to these where some of that currency risk can be hedged away, but you actually don't want to hedge it all away for various reasons. Another thing is, do these ETFs hold shares directly? And obviously in the Australian case and also VGS, that means they do. So that means if you own VGS, that it owns the various companies that it invests in, whereas the iShares S&P 500, it doesn't. What that ETF owns, it actually owns the American edition of the S&P 500 iShares. So with buying an American one that's domiciled in America, I'm not concerned about that in terms of the tax impacts. There's a few ETFs where it might be buying like an American edition which owns European shares or Japanese shares or something like that, and there can be a bit of tax leakage. But there's only a few instances where that would be the case, but it's just something to be aware of in terms of the inner workings of how ETFs work. So now looking at the exposures of the ETFs, all the Australian ETFs, that they're 100% have Australian exposure. I've just put an asterisk here because if you actually look on the websites of the individual ETFs, like it might be 97% Australian. So one reason for that is there's always a small percentage of cash that an ETF holds, as well as there's some companies in Australia that are kind of domiciled in America in that. So although it's listed in Australia, it's actually not an Australian, it's not domiciled in Australia, so it's a kind of a technicality. but for all intents and purposes, it's 100% in Australia. And then there's obviously for those three, there's not a company too. And similar for the iShares S&P 500, it's 100% American in terms of that's the 500 American companies. And so the most, I guess, complex, if you like, is the Vanguard into the VGS. So that has 71.32% in the US, which is obviously the biggest market. Then 6.2% in Japan, 3.99% UK, and they're obviously the top three companies. So now looking at the performance, as you can see, like 1, 4 and 5, as mentioned, very similar portfolio, so you'd hope and expect very similar performance over the last 5 years, and always keeping in mind that different 5-year periods can mean different things. So this is just going back 5 years from now. So we've got 10.19% each year compounded as opposed to 10.27. And in terms of what that looks like with these, that 10,000 invested 5 years ago, not including tax or anything like that, has turned into about 16,300 and 16,244 in terms of number 4 and 5. And now looking at number 2 and 3 in terms of the international shares one and the S&P 500. As mentioned, that the S&P 500 is within VGS, it has a lot of the S&P 500 effectively within that, so you'd expect there to be some kind of correlation, but obviously then there's other holdings in terms of other international companies. So you can kind of think of this as a clue to say that, well, the S&P 500 has been one of the drivers of that performance, and then the rest of the world kind of has brought it back down to 13.66%. As opposed to 16.05%, and that's annualized, and again that would turn into about $10,000 has turned into 18,968 in terms of the international, and then 21,000 in terms of the just sole S&P 500. So that's all of the different categories, and I guess would I invest in these? I have recommended and invested in both these Vanguard products. If I was an advisor in the early 2000s, I'm sure I would have advised on these ones as well. But Vanguard's kind of just been more competitive until recent times when these others have reduced their fees as well. So I have recommended those, usually certainly as part of a broader portfolio, in terms of there might be a couple of additional ETFs on top of that. And again, there's probably, without naming any names for today, whilst I would still recommend these, there's probably a couple of others that have kind of put the fight to Vanguard over the last year or so. And again, probably splitting hairs, but there would be a couple of other names that I would include in there. I guess that's to say that all of these are quality and or worthy of consideration, although there's some double up in terms of 1, 4 and 5. In terms of if I had to kind of rank, or if I had to choose one, if someone said you can only choose one, you can't have any others, I'd probably choose number 2, Vanguard International Shares, just because it's the most diversified in terms of across countries. Outside of that, I'd probably go to the S&P 500 again, because it has the 500 companies, and the American market's probably more diversified than the Australian market, given it's not just, I guess, banks and miners, and it's obviously less concentrated. Out of the Australian ones, I would say that I'd probably choose Vanguard out of these ones on this list. One of the reasons for that is just because it has 300 companies as opposed to 200, but I wouldn't be stressed about if you chose any one of those. Thanks for watching. If you'd like a copy of this sheet, there's a link in the comments and you can download it and play around with it. If you have any questions, feedback or suggestions for future topics, put them in the comments and I'll reply. And if you'd like more content like this, please subscribe. And I'll see you next time.